I got a wonderful privilege of talking about proactive tax strategies. So I want to share this with you guys, and this is a true story. This happened to me, Andy. I got a phone call from my CPA around about October with a big surprise. Andy and I were just talking about surprises. And in that surprise, I mean, I had to do everything in my power not to start swearing, as I'm a good Christian man. And he's a good one too. And I said, I don't like surprises. But what was pretty amazing to me is what happened in the next month and a half. And that is that through proactive strategies that I now apply in my own world and putting our heads together, I was able to reduce my tax bill by $200,000. That's a big number.
Wow, it's a big number.
And so not only do I profess these things work on an ongoing basis, it's actually worked for me. And sometimes it takes not just one mind, it takes maybe 2 or 3 minds. But the power for me about the US tax code, and I say US tax code because you all know I'm from here, right? The most beautiful city in the world. That's Cape Town, South Africa. The difference in the tax code, I think, in other places in America and the tax code here is that he who understands how to use it benefits, and not benefits small, can benefit pretty large. Okay? So it sounds too good to be true what I'm saying to you as I'm listening to myself, but let's just say there's a lot of pages in the tax code, 72,000 pages. Most of the times when we talk to our tax professionals, we're looking at it from the rear view. And normally it just gives us the number, that number, which is whether or not we got a refund or we paid in. The question is how can I use all that tax knowledge to change the number this year and change the number every year after this year? This is what I'm going to be sharing with you tonight. And so as I look at the tax code, there's really 3 areas. It's reducing my current income taxes. The biggest thing that has to happen, as you heard me say, is that your mindset has to change. You have to start thinking about your taxes of this year in this year. That's tax planning. Then I'm going to share some ideas with you about tax-efficient strategies to preserve and grow your wealth. So we can get into some concepts and ideas that can help you reduce your tax liability from now until the time you pass. And then finally, I'm going to talk to you about how to avoid capital gains tax and estate tax. You know, today I met with a lady who's 87 years old, who has done a phenomenal job in being very conservative in the way that she and her husband created their wealth. But I literally had to write it down for her. Now imagine I'm sitting with an 87-year-old lady whose husband handled the finances their entire life. And I am getting up from my seat, I'm taking my markers, you know, I go to my board, which is my door, but my wall, right? And I'm writing the number $32 million. And I wrote it that big, and I looked at her and I said, I got to write it this big for you to really register what I'm trying to say to you. Your estate is worth $32 million. And then I wrote down here and I said, $4 million. That's her estate tax. And I said, if we don't have this discussion, if we don't complicate matters a little bit, if we don't get ahead of this, this is what you will be giving away to the government. Okay? So whether your estate is 3.2 million or 32 million or somewhere in between, that tax right there, avoiding capital gains and estate tax, is pretty stinking amazing, because you can plan it away, but you got to do one thing different. You got to get on the front foot. You got to change your mindset. It has to be on the front foot. Now, most of you are dear clients, and you heard me say this over and over again. I'm more talking to, like Susan said, your friends. I'm talking about the fact that most people pay way too much taxes because they don't want to take the time and effort. I know it's hard to go sit down with somebody and have a conversation with them, okay? I'm going to show you guys how we have conversations, But keep in mind, I know you guys have seen this, we've implemented a lot of this for you, we're in the process of implementing more of this for you, but these are great things that you can share with your friends and help them reduce their tax payments as well. All right, so let's dive into it. What are some of the things you can do? And some of these ideas are not applicable to you, but it depends upon if you're still in the working phase of your life. But a health savings account, I've always have seen to be such an idea that most people don't know about. And this is while you're still working, before the age of 65, you can implement a health savings account. This is the one area in the tax code that you can put monies into an account, and when you pull the money out, it is tax-free. And it has to do with how much money you could put into there, right? Single or married filing jointly. I wish we could put a bunch of money in there, but we can only put so much in there. And it depends upon your filing status and whether you're over the age of 55 or not. But I have one of these things. And so when I go to the doctor or dentist, I use my debit card and I just pay that medical expense, boom, and it's tax-free money. But I got the deduction when I put the money in. So we optimize this as a family. We put in about close to $8,000 a year into this account and we use it tax-free. Health savings accounts can grow now as well. So you don't have to use, you don't lose the money if you don't use the money. That's called a flexible savings account. These things you can grow tax-free. Next thing is qualified plan designs. This is more for business owners, but it's really the way you design this. This is a pre-tax investment vehicle that you can put monies into. The next one is employing your children. This is a good concept if you still have a business, right? You can employ your kids. Phenomenal concept. Literally, I have been deducting $35,000 to $40,000 a year because I got 3 boys that works in my company, because back in South Africa we worked for allowances. So they worked here, and now I've groomed them into where Hilton now is becoming part of the practice. And then my youngest is going to come into the practice most probably too. Charitable giving strategies. This one is relevant to most of you here. When you have an IRA, and you love to give money or some of your monies to organizations, non-for-profit organizations, when you're over the age of 70, you could move up to $100,000 out of your IRA direct to non-for-profit organizations and pay 0 tax. Okay, it's called a qualified charitable distribution. Boom. All right, a lot of people don't know about it. That is my alarm clock in the morning, Maria. I just woke up. I'm just awake now. The second idea in charitable planning is this. This is called a pooled income fund. But some of you are not working, but quite interested in a way how you can put money into an account that can grow for your future, tax deductible, and come out income in the future on a tax favorable basis. Who would be interested in that concept? Yeah. You can do this over and above if you're contributing to a 401k. If you're not working anymore, this idea still is relevant. Depending upon your age, if you put $100,000 into this account, you can get a $60,000 income tax deduction this year. The money grows inside and produces an income for the rest of your life, for 2 lives. If you're married, 1 life if you're single.
What's it called again?
It's called a pooled income fund. Pooled income fund. Okay, it's a way to be able to save, even if you're retired, money on a pre-tax basis if you want to create a deduction this year and generate income for the future. This is a concept, again, that you could use. We just had the Masters tournament. Who watched the Masters on TV? Amen to that. It was quite the spectacular ending. Well, believe it or not, the people in Augusta, they got a tax code passed that allows them to rent their homes out up to 14 days for the people who's flooding into Augusta to watch the Masters. And when they rent out their home for 14 days a year, The rent income is tax-free. So when you have a business, you can use your own home for business purposes up to 14 days and deduct the amount of money that is market related for the renting of that house during the year. This is how I personally deduct about $40,000 of income, because I use my home as a place where we do team meetings. There's two people that get benefited more than others in the tax code: farmers and business owners. And as I was preparing for tonight, you perfectly asked that right on cue. I was going to say that to you. As I think about just like the way I'm retiring is being a business owner. All right? The way you're retiring, be a consultant. If you don't want to be a consultant, the tax code, like these kinds of ideas, it's tough to be able to implement. But there's other ideas you can implement. I'm just giving you a little bit of a taste of outside the box ideas that you normally don't hear from your CPA. Okay? I just want to give you a window of things that people do every day when you lean in to speak to tax professionals to help you proactively plan your taxes. Okay? Now, I'm opening up my own personal tax return a little bit to you as far as the ideas that we are utilizing on an ongoing basis. Now, we have this piece of paper here that says 40 income tax planning ideas. All right? So let me see, are we up to, excuse me, we are up to 49 ideas. So I use this. This is my intellectual property. This is my, nobody takes this piece of paper, okay? These are my ideas, and I've accumulated this over 26 years of working with tax attorneys and CPAs. And it's my attempt to put on a piece of paper every single thing that a person possibly can do, depending upon their set of circumstances.
So are those here?
No, I'm not going to. I don't publish that. It's my secrets here. These are some of the 5 of the 40 ideas. Okay, that's all I'm saying here. The ones that's probably most relevant to the folks in the room is you should think about qualified charitable distributions. You should think about a pooled income fund. Those are really cool ideas. Health savings accounts for those who are still working in consulting. Absolutely. Okay, and qualified plan designs for those who still have a work on income happening. Now, here's the rest of everybody else. The source of the income. This is relevant to every single person. Our trade secret is the fact that we actually do financial planning, as many of you have seen. Our trade secret is that we take the time to understand truly what you want to do with your money, and we create a cash flow projection of your money. That's how we are probably different than most. That with a combination of proactive tax planning ideas, which you don't get anywhere. You don't get it from your CPA. All right, you want to get it from your CPA, but you just don't get it from your CPA. If you are the one who files the taxes, good luck. It takes a lot of education to go through the tax code, okay? But those are probably some of our uniquenesses. I said it to a person today, one of our new clients, I say there's 3 things. It's plan, it's tax planning, and it's reducing your risk and driving your returns. Those are the 4 big things we do. Now, the source of the income, meaning where I pull money from to be able to live on. When you're in retirement, you have multiple accounts, different accounts from which you can pull the money from. The source of the income determines your tax liability. At the same time, you have a cash flow desire of money that you're desiring to come to you. If you want to manipulate your taxes, dial it in. It's a selection from where you're pulling money from that you could use to radically reduce your taxes. What do I mean? As we grow our wealth, also, there are tax inefficient and tax efficient environments in which we grow our wealth. All right, this is the best way. It's a busy chart, but really it falls into one of three buckets. You all know the way that we break down your master planning spreadsheet is we put taxable investments, tax deferred investments, and tax-free investments. Okay, so you can have the same mutual fund grow in the same environment. In all three of those environments, I have a radically different result. So what is after tax and taxable is typically brokerage accounts in here. If I pull from here, it represents some kind of income. It's either ordinary income or capital gains. This is where most people's monies are sitting, right? This is the 401k IRA. When I pull money from here, it's only ordinary income, no matter what I do. And when I pull money from here, this is tax-free income. So simply said, if I need to have $100,000 and I'm pulling $30,000 from here and I'm pulling $40,000 from here and I'm pulling $30,000 from here, what is my taxable income that year? It's this one and this one. And if I'm smart here, I can make that capital gains tax. How much? What is the capital gains tax rate? 15 for most people. What is the income tax rate? Yeah, it's different for everyone, 25 to 30%. Capital gains is taxed roughly at about half of what ordinary income is taxed at. Do you see the differences? So if I design it in such a way that from here I'm pulling capital gain, I'm reducing the tax liability. Does that make sense? Okay. You control, believe it or not, you control where the money sits. You were always in control, you just didn't know about it, but you had choices. Okay? So what do I do with these choices today? Right? So we all know the majority of people's money is sitting here and here. The minority is sitting here. The only reason that most people don't have a lot of money in here is because nobody made them aware early enough in life. So what we have to do today is we kind of have to reverse this. We have to solve the problem, right? We got to think about this. You see, America woke up 2 years ago. You know why America woke up 2 years ago? Because the first baby boomer hit 70 and a half. And when the first baby boomer hit 70 and a half, they went, what do you mean I have to take this money out of my IRA? What do you mean? What do you mean my taxes is much higher now that I'm forced to take this money out? The first baby boomer figured out, oh my goodness, I have to take this money out because the government wants their money, and when I take all this money out of my IRA, it pushes my tax rate up, and they said, that guy, they said when I retire I'm going to be in a lower tax bracket.
They lied.
They lied.
They lied.
Okay. That's the moment America woke up. Because I understood the code, right? 25 years ago I saw that, and we've been implementing this. Like, I'm not trying to say you that I'm just going to give you an example. There's many of our clients that got over $1 million sitting in this area. It's just because somebody came alongside and told them that there are more than just whatever they thought is available in that area. Okay? So this information is pretty potent. It's very, very potent. So if you understand your tax efficient options, there's the Roth IRA and 401k, right? What we like about the 401k version today is that most people, some people can contribute to the Roth and some people cannot, depending upon your income. There's income limitations, whether you can contribute to a Roth. But in a 401k, there's no income limitations. You can make $1 million a year and have a Roth 401k. You could get interest from municipal bonds. This type of investment is becoming pretty popular right now because the interest rates is up 3.5%, 4.5% coming from a muni bond, but the interest you receive from that muni bond is tax-free. Another tool you could use for education planning for grandkids. This is a very, very great tool we use on an ongoing basis. It's return of your principal. So when you put in $500,000 in a brokerage account, we can send the returns, but if I send the principal back to you, guess how much tax you pay on that? Zero. So how we decide how to position the money back to you really influence your tax bill. Life insurance death benefits. Well, that one is great, but who wants to die to get their money? We use life insurance as actually to produce an income stream. This is a very cool section of the code, 7702 of the code. All right, this one you want to communicate with people, I would say, up to age 50. Okay, very, very, very cool idea. We put large blocks of monies in there to produce tax-free income. But these are your tools. You can, no matter where you are in life, you can use these tools. This one, this one, this one. All right, for most folks can be used today. All right, so it's just who is helping you plan that out. Now I know it's me. All right, so this is how we are thinking through your income distributions and how that looks like. So can a person contribute to a Roth IRA? Well, today I had some clients who were consulting still. They were in their 70s. He was still consulting or teaching at Valencia College. He was making $10,000 a year. And so yes, we were able to put in the max into the Roth because he had earned income. As long as you have earned income, you can contribute to the Roth. Right? But this is the conversion I talked about earlier, right? This is when we convert money from the IRA to the Roth. That's a big way. Everybody can do that one. All right? So the concept is all about when do you want to pay the tax? When your rate's up high or when the rate's low? It's low. And so really what influences your tax rate is the four things. It's the source of the income. It is how much income you need and want. Right? It's the kind of deductions you have created during that year, right? And then it is the tax rate that the government set. How much control do we have over the tax rate? Zero. Zero, right? Okay. So this is the discussion. This is, again, for your kids, your grandkids, friends. This is the discussion. So let's talk about that which is most relevant, which is, hey, should I consider doing a Roth conversion? Right? Many of you have had that discussion with you. And as you think about that, there's really these 5 things to think about. What is my tax bracket now and what will it be in the future? Most people say, well, I don't know what the future holds, but you can kind of start estimating what that looks like to figure out if this thing works or not. What will my tax bill be if I convert and can I afford it? That tax bill needs to come from somewhere, so your unique mix of investments determines whether this is a good idea or not. It has a downside in the form of Medicare surcharges. We all know that, right? And what can I then reduce to, what can I do to create a offsetting deduction? That's the big one that we try to work with our clients with us. Create an offsetting deduction in the year in which you convert, right? Many of you have seen me do donor advised funds as an example. That's a very cool strategy we can utilize to create large income tax deductions in the year in which you're converting your IRA to a Roth. All right? And when do I need this money back to me? Those are the factors we think through when we think through whether it makes sense or not. Okay? All right. Who here feels that taxes in the future is going to be higher? Who feels taxes is going to be the same? Who feels taxes is going to be lower? Who's not going to put up their hand no matter what? Okay. Thank you. All right. Subtle ways how this thing shifts. Subtle ways how this thing shifts is basically the brackets, right? The brackets are moving and they're consistently moving and the government can move them. The second thing is what deductions is available, right? And how deduction shifts ups and down. This is a very, very indirect way how the politicians change the code. You don't even know about it. It's just happening in the background. Then there is new taxes that gets issued, and then there's what we call legislative risk. Legislative risk is basically the fact that the code is written in pencil for the most part. It can be changed at any time. All right. So normally what happens is when the country goes through bad times, whether it be economical problems like depression and recessions, when wars, major issue goings down, and our government raises the tax bills in order to pay for the country's bills, right? All to say that if you have different sources of income, you're in control. If you don't, you're not in control, okay? And so it's like navigating, it's flying the plane on a year-by-year basis. There's some changes to the code this year. It snuck in the beginning of the year. It's not major. It's actually a little bit more on the beneficial side. The required minimum distribution moved to 73.
Wow.
Okay. It's going to move in 2033 to 75. So they allow more deferral inside before they start taking income.
But that can change too.
It can change, but it's moving later and later and later. Probably, you start seeing changes on Social Security pushing the age out and out. People think this is a nice thing from the IRS. It's not. They're just doing calculation on the compounding that's happening inside of a taxable account. And they know they're going to collect more taxes that way.
Right.
There's catch-up contributions and employee-sponsored plans that got lifted. You can put into a 401k these days, if you're over 55, you can put up about $30,000 a year into it. But I would suggest that most people are underfunded or don't have enough of the Roth monies. So that's where, how much should I put into my 401k pre-tax and after-tax conversation happens. This is a pretty cool thing right here. Normally when a company matches a 401k, they match it in the form of pre-tax money, but the law now has changed and you can select or elect for the match to actually come in the form of after-tax and tax-free money. So some of the changes here doesn't influence much of you guys, but that's just an update. Okay, let's talk about capital gains tax and estate tax. What is capital gains tax? All right, Herb, what is capital gains tax?
It's tax on your, in my case, my investments.
Yes.
Yeah.
Yes.
Not my income.
Last year.
Yes. Yes.
If
So,
I sell them.
yes, if you sell them. Yes. Here's where a lot of people get really, I'd say, get a really big rude awakening. This is typically if you work with the other advisors, right? The other people. Okay? What happens when you work with other people is you have large blocks of monies in mutual funds. And in a year like last year, for instance, this mutual fund goes down in value, but yet you got this big old fat 1099. And this big fat 1099 shows you that you are subject to capital gains tax, but the markets went down. All right? That really makes people angry, and it should. So capital gain is really when a transaction took place in which you sold something that is appreciated in value. The government has their sticky fingers in there, and they want to grab, they want to tax you on the appreciation of your wealth. And that, for some people, is at 0%, but you have to have a very unique set of income. For most people, it's at 15%, and if you have high income, it can be as high as 23.8%. Okay. Now, the cool part of that capital gain, again, if you get on the front foot, you can anticipate it. You can also plan it away. There's certain strategies you can utilize. So what can you do with your capital gains tax? All right? You can pay it like everybody does. All right? So if you don't understand or don't know, you just go ahead and do what everybody else does. You pay it. But if you get ahead of it, you can defer it, you can reduce it, or you can completely avoid it. Best example I can give you, so I work with this lady, her mother worked with this company, this fruit company, early on in life. And so the mother bought some of the fruit stock. And so she bought some of the fruit stock. You know, the one with the apple, the one with that little bite out of apple? I don't want it. Well, anyway, it's appreciated to like $800,000. And the stock is pretty volatile. And she's getting close to retirement. And the stock doesn't pay a lot of dividends. But she's never going to touch it because it's got so much capital gain. All right? So what we did is we designed a strategy for her. The strategy, by the way, is over 100 years old. We created a special tax-free trust for her. We transferred the stock into the trust. We sold the stock in this trust, avoided paying all the capital gain. We took the money inside of this trust, we reinvested it into 25 other dividend-paying stock. The strategy gave an income tax deduction for utilizing it, okay? And that income tax deduction was $100,000, and her tax rate was around about 32, 33%. So the $100,000 income tax deduction equaled about a $32,000 cash savings. These type of strategies are available, and this is an example of avoiding it. And there are probably about 5 or 6 of those types of strategies in different designs, how you can utilize, okay? Now there's this area of deferring, but most people think about tax deferral is typically inside of real estate. An example of that is what we call a 1031 exchange. So when you sell a piece of real estate, you can defer the capital gain for the future. You're really just deferring, you're not avoiding, and you're not reducing, but it is available to do that. There's other versions of this where you create some deferral and some reduction. That's called opportunity zone funds, opportunity zone. That's a strategy that works right there, all right? And so then there's the avoiding strategies as well. So I'm just saying, whenever you think about selling a highly appreciable asset, or you hear of somebody that talks about selling a higher appreciable asset, just tell them there's options. There's options here, okay? I remember the first very large transaction I did was for an civil engineering group. I was working with the CEO of the company. He sold his company, and his share was $15 million. So when we calculated his tax liability in advance, he was paying about $3.2 million in capital gains tax. When we were done, he was paying 0 in tax. And we utilized a 3-tier transaction. A 3-tier transaction to be able to accomplish that. So here it is. What is the secret in this type of planning? The secret is to begin with the end in mind. The secret to take you to these types of ideas that could be relevant to you is to first start with your estate planning. How do you want to end life? If you can truly begin with the end in mind and work back, you can utilize everything that the tax code gives you to utilize. That truly is the secret. Okay? So, there's the 3 bird in 1 stone transaction. Avoid capital gains tax, avoid estate or reduce estate taxes substantially, and create large income tax deductions. Those strategies exist every day. They're over 100 years old. Most people just don't know about them because you haven't spoken to your proactive tax advisor that can help you with that. Now, full disclosure, some of these things are just not magical, okay? Some of these strategies like these, as an example, include charitable planning strategies. So when I talk about charitable planning strategies, I'm talking about this. Most people, everyone for the most part, will be a philanthropist. You have a choice. You can either be a voluntary philanthropist or you're going to be an involuntary philanthropist. That's it. You're either voluntary or involuntary. Who's the benefactor of the involuntary philanthropy? Uncle Sam, the government, right? Yeah, yeah. And most of the times when we calculate and show families what that means, it's a large number. 500, 1.5, $2.5 million that most people don't even know about. All right, so let me ask you this question. Let's just say that tax liability is $1 million. What would you prefer? To choose where that money goes that is aligning with the passions of your heart to make a difference, or to pay for a bomb or two? For a bomb or two, or some fuel, pay for about, you know, one plane ride or a few plane rides for the president. This one, or the way that you want to make a difference in the community. Okay. So most people, given that choice, they like that one, they don't want this one. So you're going to be a philanthropist. But man, can we reduce the involuntary part in a big way. All right, so some of these strategies include a lot of that types of ideas. All right, so I've covered a few areas. I said, hey, if you're proactive, we're going to still continue to look at proactive strategies. We keep our eye on the tax code on an ongoing basis to see if there's anything new that we can utilize. Sometimes when we do this planning, I feel like I'm one of these little TV game guys, Mario, that runs and bing, 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 bing. I pick up these little coins. But you put a bunch of those coins together, what do you got?
A stack.
A little stack, right? All right. So it's always one of those areas where we can make a big difference when we work with folks. Now, as many of you know, there's a lot of different directions. A lot of people say things, right? There's a lot of talking heads. You should do this, you should do this, you should do this. All right? I guess what we do is we just analyze what you personally should do. All right? And we use this. You guys recognize this, right? Here's where we quantify the impact we can make, right? All right, so in this area right here, proactive tax strategies, we can kind of look at that. Now, something that's cool about this is when you come in for another strategy meeting with us, we'll show you now in our strategy meetings, we show you where you are now, and we can still identify what else we can do. Because a lot of times you can't just put a magic wand and everything changes, right? It's corrections, it's course corrections. As we kind of journey together, we can make those course corrections. And so you'll see us do that during our conversations, during our reviews. All right? So this is the secret. You guys have seen that. A lot of you have seen that and experienced that, right? It's when we truly understand the vision and the priorities and the goals. We can set the plan that you'll love. That's the cash flow plan. Now we can go through the tax strategies and risk strategies and return strategies, and then get to the tactics. These unique little ideas that I've shared tonight with you, okay? All right, so there it goes. That's how we start the conversation. Some of you are just in the middle of that conversation. There's a cool destination. There's more to life than taxes, right? There's more to life than taxes. So what's cool is that if you know what you want, I said this to a guy I was interviewing today, actually. We're interviewing, we're growing the team, and I said, man, if you can just tell me what you want, I can figure out if I can help you. Here's the thing about what I learned about asking people what they want. Most people don't know what they want. That fair? Most people know exactly what they don't want. Is that fair? See, most people know what they don't want, right? So if you want to figure out what you want, just figure out what you don't want. You know what you don't want, and you'll kind of start figuring out what you want, all right? But here's the exciting part for us, all right? You guys know we're passionate about dreams, and we're passionate about helping you accomplish your dreams. That truly is what gives us great joy and fulfillment. It's like our world's intangible. The way our world becomes tangible for us as we work with you is to see it through your eyes. So keep on dreaming, keep on accomplishing, keep on doing the things that makes you come alive, right? Let us worry about the taxes and help minimize it. Every time I move money from the tax man over to you, it's more fuel to see more dreams come true. And for that, we are very thankful and honored that you've given us that opportunity.